While everyone was watching the headlines about Bitcoin and tech stocks this week, something far more dangerous quietly shifted behind the curtain in the silver market. January 19, 2026. The Federal Reserve just signaled through their dot plot, through their minutes, through the quiet whispers coming out of Washington that 2026 will see only one interest rate cut, maybe none, maybe even a pause that looks suspiciously like tightening in disguise. They're calling it higher for longer. The market is calling it a death sentence for paper silver shorts, and a massive head fake for anyone who thinks the easy money is coming back. This is not a drill dot. This is the moment the macro environment turns from silver's best friend into its most vicious temporary enemy. Welcome back to the channel. If you've been following the silver story for any length of time, you already know we don't chase noise. We track the plumbing. We follow the liquidity. We watch what the institutions do when nobody is looking. Today we are going to do exactly that. We're going to dissect the Fed's new pause posture, what it really means for the US dollar, how it creates a short-term pressure cooker for silver prices, and most importantly why this exact moment of apparent weakness is the setup for the most violent upside leg we've seen yet. If you value serious analysis over entertainment, if you make decisions based on data and not emotion, then go ahead and subscribe right now. We don't post every day. We post when the data changes the game, and today, the data just changed the game. Before we continue, drop a comment below. Are you in North America, Europe, Asia, Pakistan, India? Let us know where in the world you're watching this from. We're building a global community of people who refuse to accept the official narrative. Now, let's get into what actually happened this week, and why it matters so much more than the headlines are admitting. Let's establish the facts first. At the latest FOMC meeting, the median dot plot moved from 3 projected cuts in 2026 down to one lonely cut, one dot core. PCE inflation came in hotter than expected. Jobs data refused to crack. And several voting members, people who actually sit at the table, started openly saying, "We may be done." Powell didn't say it outright, but the message was crystal clear in the minutes. The bar for further easing has been raised significantly. Translation: the Fed is now comfortable letting rates stay restrictive longer than Wall Street priced in. And what does restrictive really mean when you're talking about the world's reserve currency? It means the US dollar gets stronger. It means capital flows back toward dollar assets. It means yield-seeking money leaves commodities and goes back into treasuries. And right now, silver is one of the most sensitive commodities on the planet to dollar strength. So the math is brutally simple. Stronger dollar equals lower commodity prices in dollar terms. Lower commodity prices equals short-term pressure on silver. We've already seen it play out. Silver pulled back from the $94.30 high to the $90.50 zone in the last 48 hours. That is not random. That is textbook macro reaction. But here's the part that should terrify the shorts and give you, the physical holder, the calmest sleep you've had in months. This pullback is not the end of the story. This pullback is the setup. Let me explain why. First, the Fed's pause is not happening in a vacuum. It is happening against the backdrop of the most ferocious structural demand shock silver has ever faced. China's export licensing regime is now fully live. India is buying physical at $12, $18 premiums. Solar manufacturers are locked into contracts that require silver paste, regardless of price. AI data centers are devouring silver at rates that make 2024 look quaint. All of that demand is inelastic. It does not care if the Fed keeps rates at 4.25 to 4.50% for another 6 months. It does not care if the dollar index rallies another 3 to 4 points. These buyers need the metal. They will pay whatever it takes. Second, the paper market is already showing cracks. We've entered periods of backwardation multiple times in the last 60 days. Shanghai premiums are running 10 to 15% over London. US Mint has suspended sales again. Dealers are pulling catalogs offline to When the Fed's pause strengthens the dollar and temporarily suppresses the paper price, all it does is widen the arbitrage gap between paper and physical. The bigger that gap gets, the more violent the eventual snapback becomes. Third, history is screaming at us. Every major silver bull market in the modern era 980-2011, even the smaller 2020-2021 run had exactly this pattern: a macro headwind, strong dollar, Rate hikes, Fed tightening creates a vicious shakeout, followed by the most parabolic leg up once the macro pressure eases or the physical demand simply overwhelms the suppression. We are watching that exact pattern play out again, right now. So let's do the quick math on the downside risk and the upside potential. Short term, next 4 to 12 weeks, if the dollar index pushes another 3 to 5%, silver could easily test $86.80, $8 again, maybe even a quick flush to $84 if the leverage crowd panics. That would be painful, that would shake out margin traders. That would be the classic final capitulation before the next leg. But look at the fundamentals underneath. Annual mine supply is still stuck around 850 million ounces. Industrial demand projected to exceed 7 million ounces in 2026. Investment demand already at 300 million ounces per year and rising. Cumulative deficit since 2021 already over 900 million ounces. Even if silver dips to $85 on a strong dollar scare, the physical buyers will step in harder. The gap will widen further. The next arbitrage wave will be even more violent. And when the Fed eventually pivots, because they always do when the economy starts to crack, that same dollar strength reverses. And when it reverses, silver doesn't climb, it explodes. So here's the balanced, cold, hard view. Yes, the Fed's pause is real. Yes, it creates short-term downside pressure on silver. Yes, we could see a $5, $10 pullback in the coming weeks if dollar momentum continues. But no, this is not the top. No, this is not the end of the bull market. No, this is not the time to sell physical. This is the shakeout. This is the volatility designed to liquidate the tourists and the leveraged. This is the moment the banks try one last time to buy time before the structural forces overwhelm them completely. If you are holding physical silver in your possession, stay calm. The ounces didn't disappear. The weight is the same. The fundamentals are stronger than ever. If you are still sitting in cash or paper instruments, this dip is the last clean opportunity before the train leaves the station for good. The path to $100 is not going to be smooth. It is going to be violent. It is going to test every ounce of conviction you have. But the destination has never been clearer. The macro pause is temporary. The supply squeeze is permanent. The industrial demand is relentless. Silver doesn't need permission from the Fed to go to triple digits. It just needs the paper suppression to fail one more time. And right now, it is failing. Thank you for watching. If this breakdown helped you see through the noise, smash that like button. Subscribe if you want to stay ahead of the next move, and drop a comment. Do you think we see $85 before $100? Or does the physical demand break the paper market first? This is Wealth Unwired. We don't follow headlines. We follow the plumbing. Stay stacked. Stay patient. The real move is still ahead. See you in the next one.